Welcome, everyone. My guest today is Lead Analyst Logan Mohtashami to talk about the U.S. economic picture, including the jobs report, mortgage rates, and what the demographic overlap of Millennial and Gen-Z homebuyers will mean for housing. As always, I want to thank our sponsor, Optimal Blue, for making this episode possible. Logan, welcome back to the podcast.
Happy birthday to you. Happy birthday to you. Happy birthday, dear Sarah Wheeler. Happy birthday to you.
Wow, I really appreciate that. Thank you. One day early since we're doing this on Friday, but how nice to be serenaded, as it were.
Yes, and we have, and we're closing out year 2024, and you and I have been working 5 years. There's nobody else on planet Earth I would have rather shared this 5-year period than with you. And we're closing it out with no housing bubble price crash, no recession. That's what we do. We track economic cycles and housing data. And in the most craziest 5-year period in history.
Crazy.
Right?
I mean,
we were able to do it by providing the most legit information to the viewers possible.
I totally agree. And I'm so glad we had you through 2020. And then in all of the things since then, I feel like every year I'm like, well, it can't get more interesting than this year. And then it does. So very happy to have you. Would wish in some ways for less interesting times, especially for our industry. So let's talk about, oh, go ahead.
But you know what? This is why that February Housing Economic Summit in Dallas is going to be so interesting. I don't remember like having been part of an economic summit all in one day with so many different people that are very good at their job. And by that time, spring is here. So the timing could not be perfect for anybody that's in the Texas, Dallas area. That event is going to be wonderful.
It's a really different kind of event because normally we'll have you and another economist, we'll have Mike and you, we'll have, that's how it usually goes. This is like a whole day of economics really built out, broken out into like demographics, inventory, mortgage rates, home building, what's going on with just every part of the economy with some of the best voices. So cannot wait. February 26th, everybody mark your calendars. It's here in Dallas, and Logan, of course, is our keynote. So
what am I going to wear? Oh my, Texas. I got like Texas shirts and stuff, but I got to get some boots for that.
You need some boots for sure. Okay, we're recording this on Jobs Friday, and that it was exciting this morning. Tell us what we should take away from the jobs report.
You know what's interesting about Jobs Week? Of course, Jobs Week is critical in terms of the bond market and mortgage rates. This week was literally a giant snore, in terms of the labor data and its effect. Oddly enough, as we wrote in the article, the ISM service sector index, that data line actually pushed the 10-year yield lower faster than anything else this week. So the labor data is basically doing what I thought it would always do. It would get to a certain level in terms of monthly job creations. We highlight that in the article. Labor data is getting softer, but it's not breaking. So the bond market and the Fed is like, okay, we need to see more deterioration to take that next step. That's the whole 2020. The Fed's not going to really pivot like people want until the labor market is breaking. Breaking is jobless claims, right? And even in this report, residential construction workers, just a little smidge of growth there. And remember, that's not all apartment construction workers and single family. It's remodeling business as well. So that's why the labor data is slowly still trickling up a little bit higher out there. But really, no real big surprises. I think the big surprise for me is wage growth is still running at 4%. And, if productivity data wasn't good, the Fed might make that a bigger deal. But for now, that's something they don't really want to see, but they're willing to forgive it for the sake that productivity data has been better.
Okay, so that leads, of course, to my next question, which is, how is the Fed going to look at this data? Does it make them feel better about a rate cut? Does it make them pause about that? Does it have any effect at all?
They're going to cut in December, and then it's going to be a wait and see for all of 2025, which means we might not get consecutive rate cuts anymore.
Ah,
It'll be more timed unless the labor data gets weaker. That's the vibe that I'm getting. I always like to see what the Fed presidents are saying, hawks and doves and everything, and I just get the sense that this is the honest truth. Everyone's been wrong about the economy for a very long time. GDP is running at over 3% for Q4 right now. Consumption is still doing fine. So, in the Fed's eye, they can take a little bit more time in it. Whether people agree with that or not, it looks like to me they'll cut in December and they'll decide, okay, we'll take our time to see if we need to do anything more out there. Which is the irony is the one sector that is looking very weak in terms of its labor is housing, and then that really revolves around the 10-year yield more than the Fed funds rate. So look for the Fed to say, okay, well, they'll cut a quarter, but we're just going to be a wait and see. They want to get down to a neutral level and then just stay there until the labor data breaks. And then when it breaks, then they'll go, okay, I can't believe we waited so long. But in that case, that's where I think we're going with the next Fed meeting.
well, I mean, good that they're going to do this rate cut in December, but kind of disappointing that we're not seeing that. But you've said this all along, until the labor market breaks, there's not going to be any big rate cuts. Nothing's going to really change.
Paper, rock, scissors, labor over
Labor
inflation.
over
And
inflation.
it is interesting because productivity data has been so good. 4% wage growth is tolerable for now, but in any other normal circumstances, the Fed would be furious that wage growth is running at 4%, inflation is running below that, and the productivity story in America is really interesting. I mean, let's just admit it, Europe sucks. Let's just admit it. There's nothing good comes out of Europe. They don't create anything. They fight with each other all the time.
Do you mean economically? I mean,
just
you can't just say,
economically, they're just not a powerhouse, right? Everybody says the dollar's going to collapse. I encourage everyone, nobody's going to do this. Go look at the SWIFT payments of the euro. It's been going down. Everybody's focusing on Godzilla, King Kong, our economy, and they're like Europe is like that's been going lower. So. If this productivity story is legit, which I don't think the Fed doesn't believe the productivity, it's going to be one of the more remarkable things that to come after COVID is this growth in productivity, and if it could just sustain. I'm always skeptical of any productivity data. The trends have been going lower for a very long time, but if this sticks, man, 100 years from now, they'll talk about this. You don't hear about this much in general context, but the productivity story in America is a good one.
that is a good one. Okay, so for the moment, no big changes in mortgage rates coming that we can see, either
No,
up
but
or
I think the people that were like, oh my God, tariffs, oh no, here it comes. Mortgage rates 7.5, 8. We know who these people are, right, Sarah? In this context, I think I've always said the economic data runs the show. Bond yields were rising as the economic city surprise index and data was beating expectations. And then that data line stopped beating expectations and started to fade. And the 10-year yield started to fade. That downtrend from 5% is here. And mortgage rates are going to end up below 7%. So we've had a little bit move lower in rates. Nothing spectacular, but I think there was a lot of overreaction after the election. So hopefully those people learn that economic cycles and rates and the 10-year yield, the slow dance, right? The slow dance is what really moves the show. And that's been proven time and time again for decades, well before even I was born.
well, we will see. I agree with you. Of course, about rates, and I do not. But tariffs could affect the cost of goods. We will see how this affects home buying, home building next year.
I don't think it'll be that big of an issue, to be honest. I
Okay.
mean, I think there's, what's interesting is there's a lot of things that go into the lumber trading and, Canada fires and sawmills being shut down, stuff like that. But, it's tariffs are always going to be one-time price adjustments. Trade wars itself are never a good thing. It's always going to be a net tax on someone, but always kind of remember that we did this in 2018, 19, and nobody got the results they wanted. But it wasn't inflation breaking out. And I encourage everyone, just you could go back and see, the CPI data back then, the PCE data. So I think people are like mixing up things that don't kind of work. And always remember, President Trump talks a lot, and it's a lot of this is negotiating. And literally, you could go back. There were more negative revisions to the 2018-19 jobs data than what we saw recently here. Business investment just went down to zero. So there, like we talked about before, there are limits to what can be done back and forth into this potential conflict that could come out in the future.
So we will stay tuned. Okay, so let's talk about what you're looking for on the tracker this weekend. What we're doing right now will air on Monday, so people can already go and look. But what is it that you're looking for? Because we had purchase apps come up again, right?
So purchase apps are acting differently now. We have a growth trend with rates elevated. That's never happened in the recent history. But the pending contracts have been holding firm much better than anticipation for like many months now. And the question is purchase application data a function of seasonality? Because if it's a function of seasonality, when you're working from very low levels, then just the sheer size of the American workforce. We added another 2 million plus workers this year. We added more than 6 million workers in the last 3.5 years. So it doesn't take much to move the needles. And I always say that seasonality can push data lines stronger than what we normally would see. And I'm trying to figure out if this is just a seasonality curve, then going out in the future, when that goes away, rates are going to be really driving the show. Because we saw this in 2022, we saw this in 2023, but rates were falling back then. So the tracker, the pending contracts, inventory is in its downturn, seasonality is kicking in. I want to see the pricing. Our weekly pricing index has just been more firm than I could have imagined. Especially after October. It was firm again last week. So these are things that we want to keep an eye on, and especially getting ready when we do our 2025 forecast. And it is interesting when you work from such low depressed levels, it doesn't take much to move the needle. But if mortgage rates just get down towards 6%, if mortgage rates go sub 6%, I promise you, everybody's home sales forecasts will be wrong. Right, because we have seen just glimpses of 500,000 more home sales being achieved with rates getting towards 6%. We just never been able to hold rates that long. So a more firmer bottom is being put in, but the rate story, man, I tell you, I'm excited about that, because if that happens, then everyone will be pleasantly surprised. But labor over inflation, right? That's the thing that we're all waiting for.
I wanted to ask you about mortgage spreads. I had Chris Whalen on the podcast, right, yesterday, and really interesting. We were talking about, hey, will Trump really bring Fannie and Freddie out of conservatorship? He gave it a 1 in 5 chance. That's his recommendation. If though that happens or starts to happen, he mentioned that more spreads would get much worse. What are your thoughts there?
Christopher is probably one of the top 3 people in America to listen to on this. And, my concern with Freddie and Fannie getting out of conservatorship, we've had a functioning lending system for 14 years. And when things get stressful, credit can not only tighten up if they're out of conservatorships, but spreads could get worse faster, because you're now dictating what the market is. And I understand how some people might just say, well, Freddie and Fannie have become too political, depending on who's control the White House. And it's just, we don't get a normal functioning. I've seen what a publicly traded Freddie and Fannie can do. And let me tell you, the stability is, everybody keeps on saying, some of these banks have been here. We've had banks go out of business within hours. The marketplace can be very, very brutal. And this sector needs stability, right? One of the most unsung heroes in the history of America, Mark Calabria, bless his heart. That man delivered for the American people because he couldn't get Freddie and Fannie out of conservatorship, and credit flowed, forbearance happened. It was one of the greatest victories ever, and that gentleman is going to go to the graves with that, but bless his heart. When you take them out of conservatorship, I'm assuming that the Treasury has to be a big player into this, because there's no way the market is going to allow these people to just go on their own. There has to be a backstop because they're just simply too big. If that's the case, maybe there's a plausible way to get there. But again, you're risking something that I don't see the net benefit anymore. I see a few wealthy people maybe holding Freddie and Fannie preferred shares making money, but I'm still trying to think advantage, disadvantage. But I could clearly see what's happening here. Nobody is putting these companies into the public sphere without the Treasury backing them up. There's just no way that they just cannot raise that kind of capital. So at least if something like that does happen many years from now, the government will still be a huge backstop for them in case things get hectic again.
Yeah, I appreciate you weighing in on that. It was a really good conversation, and I feel like he brought up a lot of points that we should all be thinking about. But again, 1 in 5, we'll see. We'll know more. He said, watch the FHFA pick. He feels like the Treasury pick is the right guy. If either way here, but he was like FHFA will tell us something there.
We have a lot more things to deal with than getting Freddie and Fannie out of all the times in history. Like this is not the time. Like, right. You need stability right about now. If rates go lower, you need credit flow. You don't need to throw any more smoke and jazz into this thing. It's been proven to work. And again, one of the most beneficial things of the COVID-19 recovery was that Freddie, and we talked about it, we wrote about it. We said a lot of people assumed, well, credit is going to tighten up. That's what happens in recessions. I said, yes, I agree with you 100% if Freddie and Fannie were publicly traded companies. I encourage everybody. We wrote about this a lot. We talked about this. It was the main point. Credit was able to flow because these two giants were not impacted. We saw lenders being frozen up, investors and everything, but no, Godzilla and King Kong kept doing it, and it was benefited the United States of America.
So I'm interested. So ever since you started writing for us, you had like put aside the years 2020 to 2024. And this is long before we knew there was going to be a pandemic and all the things that happened after that. You identified those 4 years as being really significant from a demographic point of view, right? Because the millennials would be in their peak home buying age. And ever since then, I'm like, okay, well, what happens in 2025? And you will not answer this question. You've told me very pointedly, I don't want to answer until the end of 2025.
I kind of have given hints now, you know.
Well, I'm excited to get closer to 20, a couple weeks from now, you're going to have to give us this answer because we will be in 2025.
By the way, people say it's 4 years. No, it's 5 years, 2020, 2021, 2022, 2023, and 2024. So obviously, when we think about economics is demographics and productivity. The rest is stamp collecting for my fellow nerds. Here, because home sales crashed so fast and has stayed low for so long, the demographic factor doesn't basically shut off in 2024 because we're missing. I always say 1.3 to 1.7 million home buyers are missing from the last 3 years. They did not die. So we can move this along a little bit more because those people are still living. And hypothetical, let's just say, I don't believe this is going to be the case. Let's say mortgage rates went to 4.25. And stood
that
there
would
the same
be incredible,
year.
But yeah, no.
Home sales are going up. I don't care what anybody else says. Everybody says, no, rates, home sales are going up. I would dare any human being in America, Russia, and China to tell me that home sales would not rise at 4.25. Okay. Why is that? Because most sellers are buyers. Millennials are massive. Gen Z is starting to come in there. We have a demographic edge that other countries, Europe doesn't have it. Japan is dying off. China doesn't have it anymore. The millennials and Gen Z are massive, bigger than the total population of Japan. And there's so many loser accounts out there that sit there and go, oh my God, we're dying. Look at these schools. They're shutting down their schools because there's not enough people or whatever. we are the only economic superpower in our life because of our demographics, because of our productivity, because of our ambition and risk taking. And we make stuff. We're not Europe. We're not Japan. We're not China. We are the only superpower. And we flexed our muscle once again in COVID, outdid everyone. So they're still there. But again, it's an affordability issue. So we'll take it 1 year at a time, but I'm missing a lot of buyers that would normally have been here. This is why the whole 2020, hello, oh my God, this is not a good thing. Home prices are about to take off. Forbearance crash, bro. What? Who the hell are you people? See, you deal with crazy people. Now here, we got the buyers there. So we just have to, everyone has their own affordability index and models. Rates have to come down lower to get my demand curve to go up higher. But those people are still here. They did not die off. And when you're working from extreme low levels of sales, you can grow it. It just needs rates to fall.
It's also going to be interesting because we've had a lot of other things going on. Like before before 2019, so many of the stories that we saw that people were talking about that we wrote wherever was like, when will millennials start to buy homes? And you've seen less of that with Gen Z, I think, because we've just been so busy with so many other things. But to me, it's like, okay, well, what's the overlap of these missing millennials who hit peak home buying age but couldn't do it with Gen Z coming up? Like, what's the overlap there?
You know what's interesting? Gen Z is surpassing the baby boomers as more workers.
Mm.
So they've been buying homes at a faster percentage than the millennials do. You know what's interesting? Millennials have been the biggest home buyers since 2013. The only year they lost that title was actually in 2022, just because rates shot up so much, and they're a 90% plus mortgage finance group. In this context, I think what happened was Gen Z started in a better backdrop than the millennials. Just came right after the great financial crisis. But starting in 2013, they started buying household formation. They like all younger people, they do things a little bit later, right? They get married later. They create households formations a little bit later, so their home buying is a little bit later. Gen Z is similar to that. But we have Gen Z is going to be surpassing the baby boomers in terms of the workforce for many, many years to come. And thankfully, so we have them and we have the millennials. I would think so differently about the U.S. economic system if we didn't have millennials and Gen Z.
So, and that's one of the things that plays into that, of course, is immigration, right? So we'll see how that plays out. Legal immigration. We don't have a lot of illegal immigrants buying houses. That's one of the things that you talk about.
Everyone wants to come to America because this is the only superpower left. We actually wrote about this many years ago, how we're going to have such a strong recovery that other countries, other people are going to go, why would I want to go to Europe? Why would I want to? America's where all the jobs, growth, and everything is. So we have an unbelievable advantage because since 1820, if you look at the immigration patterns of the U.S., immigrants come here, they raise their families, they have kids, they have kids, they have kids, and boom, boom, right? I mean, so much of our labor force growth going out for the rest of the century are from immigrant families coming here. If that wasn't the case, we're totally different. But that has not been the case. It's been a strength of the U.S. for over 200 years, and it will continue to be.
I'm excited as we look forward to 2025, looking forward to that economic summit, but also just the talks that you and I are going to have, the forecast you're going to do here at the end of the year, because I think it could be a really interesting year, not a bad year. Like, I don't think this is another 2023 staring us in the face for the mortgage industry, for the housing.
There is potential for upside. Again, for me, if I legitimately thought I could get mortgage rates under 5.75, everything gets better, right? It's just I haven't been able to forecast that, and we're going to go into all those variables going into next year. Remember, we do channels and ranges because we want to teach people how this works. But again, people do not appreciate what a superpower we are. Like, just our household balance sheets, our demographics, our the ability for people who want to invest here. I mean, this is it. You really want to invest in China, right? No. I mean, do you really want to kind of invest in Europe with all the regulations and everything? No, right? Japan, no. This is America. This is it. This is all of us together as a team, right? I always say that even the most bearish American crazy people, they're still part of my team because they go to work and they produce something, right? It's for me, it's just this whole 5-year period, right? I mean, we think about when did this start? COVID-19 recovery model, April 7th, 2020, retiring that model in December 9th, 2020, then the November 9th housing economic theory. And we sit here with amongst all the doomsday people, and we won. We won, and they can't do anything about it. They will all go to the graves buried as this 5-year period of constant doomers, just like they were in the last decade. People know me
It's
from the
true.
last decade was the same thing. And there's nothing they can do about it. They will, when they end this life, history will remember them.
I love the optimism. That's what we need as we head into this new year. Logan, we will talk soon. Thanks for being on.
Pleasure to always be here. Enjoy your birthday.